The cash squeeze, why physical money is quietly being pushed out. They are eliminating your ability to exist outside the financial system. And they are doing it so gradually, so methodically, so carefully, that most people will not realize it has happened until the option to reverse it is gone. Physical cash, the banknote in your wallet, the coins in your drawer, the $500 hidden in the back of a book that no algorithm can see, no bank can freeze, no government can instantly confiscate, is being systematically pushed out of the global financial system, not banned, not criminalized, not eliminated in a single dramatic legislative act that would generate the resistance necessary to stop it, pushed out, through friction, through inconvenience, through the quiet incremental removal of the infrastructure that makes cash usable, the ATMs that are disappearing at 3,000 per year in the United Kingdom alone, the bank branches closing at 4,000 per year across America, the merchants displaying cash not accepted signs that have multiplied from curiosity to norm in 5 years, the government payment systems that no longer accept physical currency, the financial regulations that treat large cash transactions as presumptive evidence of criminal intent, rather than the exercise of a legal right. The war on cash is not a conspiracy theory. It is a policy. It is documented in the academic literature, in the central bank working papers, in the International Monetary Fund research notes that discuss the elimination of physical currency as a prerequisite for implementing negative interest rate policy at the scale that the next financial crisis will require. It is the most consequential financial policy being implemented in your lifetime. And it is being implemented without a single vote, without a single public debate, without a single moment where the people most affected by it were asked whether they consented to the transformation of their relationship with money that it represents. Here is why this matters more than any missile, any market crash, any geopolitical crisis this channel has ever covered. Every other threat to your financial security operates from the outside. Market crashes can be survived with diversification. Inflation can be partially hedged with hard assets. Geopolitical disruptions are temporary by definition. The elimination of physical cash is different. It is the removal of the last exit from a financial system that can, once cash is gone, impose any condition it chooses on your economic participation, negative interest rates that tax your savings automatically, social credit scoring that restricts your purchasing based on your behavior, financial sanctions that can be applied to any individual with a single administrative decision rather than a legal process. Once cash is gone, these tools become available at zero marginal cost. The infrastructure for total financial control exists the moment the physical alternative to digital money ceases to be practically accessible. Let's establish the specific mechanisms through which physical cash is being eliminated, because the mechanism is the message, and the message is the darkest truth in contemporary finance. The elimination is happening simultaneously through 4 distinct channels: banking infrastructure, merchant acceptance, and direct government policy, each of which individually appears benign, or even progress-oriented, but whose combined effect is the systematic removal of cash from everyday economic life. The banking infrastructure destruction is the most advanced and least discussed. The United Kingdom has lost 13,000 bank branches since 2015, a 60% reduction in the physical banking network in less than a decade. America has closed more than 15,000 bank branches since 2009. Australia has eliminated 40% of its ATM network since 2017. In Sweden, the global laboratory for cashless society policy that central banks worldwide study as their operational model, cash now accounts for less than 9% of all transactions. ATM networks have been reduced by 50% in 5 years, and the Riksbank has explicitly stated that cash may cease to be practically usable within the current decade. The infrastructure destruction is not a consequence of reduced cash demand. It is the cause of it. Remove the ATMs and the bank branches that make cash accessible, and you manufacture the reduced cash usage that justifies removing more ATMs and bank branches. The policy creates the evidence that validates the policy. The merchant acceptance channel is where the elimination becomes visceral for ordinary people. Sweden, Denmark, and Norway have passed legislation permitting merchants to refuse cash, reversing centuries of legal tender law that required businesses to accept the currency issued by the state. Australia's largest retailers have introduced cash-free checkout lanes. Amazon's cashierless Go stores are architecturally incapable of accepting physical currency. The London Transit System eliminated cash acceptance across its entire network in 2012, making physical currency literally useless for one of the most essential daily transactions in one of the world's most important cities. The United States is following with a lag of approximately 5 to 7 years. Major American cities, San Francisco, New York, Philadelphia, have passed laws requiring cash acceptance in response to grassroots resistance that has so far slowed but not reversed the trajectory. The regulatory channel is the most financially consequential. The Bank Secrecy Act in the United States requires banks to file suspicious activity reports for cash transactions above $10,000, a threshold set in 1970 that has never been adjusted for inflation. meaning it now captures routine business transactions that would have been considered small in 1970. The $10,000 threshold has been supplemented by structuring laws that criminalize making multiple transactions below $10,000 to avoid reporting requirements, creating a legal framework where using cash in amounts that any small business routinely handles is presumptively criminal behavior. The European Union's fifth anti-money laundering directive has imposed cash transaction limits of €10,000 across member states, with several countries implementing limits as low as €1,000 for specific transaction types. These regulations do not eliminate cash. They make using cash above trivial amounts legally hazardous for ordinary citizens while doing essentially nothing to impede sophisticated criminal enterprises that have access to the same cryptocurrency, shell company, and correspondent banking channels that have always been the primary tools of large-scale financial crime. The direct government policy channel is where the agenda becomes impossible to misinterpret. India's 2016 demonetization, the overnight withdrawal of 86% of all currency notes in circulation, affecting 1.3 billion people with 4 hours' notice, was the largest and most aggressive cash elimination operation in history. The official justification was combating black money and corruption. The actual consequence was forcing the entire Indian economy onto digital payment rails, UPI, Paytm, bank transfers, at a speed that the market would never have achieved voluntarily. Nigeria's 2023 cash redesign, replacing existing banknotes with new ones on a timeline so compressed that most citizens could not exchange their old notes before the deadline, forcing mass migration to digital accounts, followed the identical playbook with identical official justifications and identical actual consequences. The pattern is not coincidental. It is a policy template being applied across different jurisdictions at different speeds, calibrated to local resistance capacity, but directed toward the same destination. The hidden financial force powering all four channels simultaneously is the one that central bank working papers discuss with a candor they never deploy in public communication. Negative interest rate policy, the tool that the IMF, the Bank for International Settlements, and multiple major central banks have identified as the necessary response to the next severe financial downturn, is functionally impossible to implement at scale, as long as physical cash exists. Negative interest rates mean charging depositors for the privilege of holding money in the bank, a tax on savings that is the only monetary tool capable of forcing consumption and investment in a balance sheet recession where conventional rate cuts and quantitative easing have already been exhausted. Japan has tried negative rates. The ECB has tried negative rates. Both discovered the same structural limit, below approximately negative 0.5%. Depositors begin withdrawing physical cash and storing it rather than accepting the negative return. Physical cash is the exit valve that prevents negative interest rates from being applied at the depth and duration that the next balance sheet recession will require. Eliminate physical cash and the exit valve closes. Negative 2%, negative 3%, negative 5% become technically implementable. Your savings can be taxed at whatever rate the monetary authority determines is necessary, without any ability on your part to opt out by converting to a form of money they cannot reach. The elimination of physical currency as a tool of financial control is not a 21st century innovation. It is one of the oldest power dynamics in the entire history of monetary systems, the perennial conflict between the issuer of money, who benefits from controlling its form, and the user of money, who benefits from holding it in a form the issuer cannot manipulate. This conflict has been decided, repeatedly, in favor of the issuer. And each time it has been decided in favor of the issuer, the consequences for ordinary wealth holders have been catastrophic in the specific, predictable way that removing monetary exit options always produces. Study the Roman Emperor Diocletian's edict on maximum prices of 301 AD. The Roman monetary system had been debased for a century, the silver denarius reduced from 85% silver content in the 2nd century to less than 5% by Diocletian's time. The debasement was the Roman Empire's cash squeeze, the systematic reduction of the currency's intrinsic value to fund imperial expenditures that the tax base could not support. When merchants and citizens responded rationally by pricing goods in terms of real value rather than nominal denarius face value, effectively opting out of the debased currency system through barter and gold transactions, Diocletian's response was the Edict on Maximum Prices, which imposed death penalties for charging above official prices, and the currency reform of 301, which attempted to force acceptance of the debased currency by eliminating alternatives through legal compulsion. The edict failed catastrophically. Merchants withdrew goods from the market rather than sell at prices that guaranteed losses. The black market expanded, trade contracted. The attempt to eliminate exit options from a debased monetary system accelerated the economic deterioration it was designed to prevent. The Roman parallel is not exact because digital currency is not debased in the same way that clipped coins are debased. But the structural dynamic is identical. A monetary authority whose currency faces exit pressure from a more honest alternative, gold and silver in Rome's case. Physical cash in the modern case responds by attempting to eliminate the alternative rather than by addressing the conditions that make the alternative attractive. the elimination of the alternative does not solve the underlying problem. It removes the market signal that the problem exists while allowing the problem to compound to a scale that eventually becomes catastrophic regardless of whether any exit option remains. The British experience with the gold standard in the 20th century provides the more financially precise parallel. Britain suspended gold convertibility in 1914 to finance the First World War, eliminating citizens' ability to exchange paper pounds for gold at a fixed rate. The suspension was described as temporary. It lasted until 1925, when Winston Churchill restored convertibility at the pre-war parity, a decision that deflated the British economy for 4 years and contributed directly to the general strike of 1926. Britain suspended gold convertibility again in 1931, permanently this time, under pressure from a financial crisis that the maintenance of the gold standard was making unsurvivable. The final elimination of the gold exit option, the closure of the last mechanism by which British citizens could convert paper claims to hard assets at a guaranteed rate, transferred to the Bank of England, the complete freedom to manage the currency for macroeconomic objectives without constraint from citizen exit behavior. The pound lost 80% of its purchasing power in the 40 years following the permanent suspension. The freedom to manage the currency without the discipline of a convertibility constraint produced exactly the monetary inflation that the gold standard's exit option had previously prevented. Physical cash is the 21st century's gold standard exit option. It is the mechanism by which citizens can opt out of digital monetary manipulation. Negative rates, programmable money with expiration dates, spending restrictions, behavioral compliance requirements, at zero cost and with complete privacy. Its elimination is the closure of the last convertibility window. And the monetary history of every previous closure of every previous convertibility window suggests that the freedom from citizen exit discipline that the closure provides will be used in exactly the way that freedom has always been used throughout monetary history, to serve the interests of the issuer at the expense of the holder, gradually, then suddenly, then irreversibly. Watch 4 specific developments in the next 24 months that will tell you how far along the cash elimination timeline actually is and how much time remains before the exit option closes permanently. First, watch the central bank digital currency implementation schedule across G20 economies. The Bank for International Settlements reported in 2023 that 93% of central banks are actively developing CBDCs. China's digital yuan is already operational across 26 cities with 260 million individual wallets. The European Central Bank's digital yuan is in the preparation phase, scheduled for implementation decision in 2025. The Federal Reserve's FedNow system, not technically a CBDC, but a real-time payment infrastructure that provides the rails for CBDC deployment, launched in 2023, and is already processing transactions across 500 financial institutions. When the first G7 central bank announces a mandatory CBDC adoption timeline with a physical cash phase-out date, the window is not closing, it is closed. Second, watch ATM network contraction rates in your country specifically. The global average ATM network is contracting at approximately 5% annually. In countries above that rate, the UK, Australia, Sweden, Canada, the practical accessibility of cash is deteriorating faster than the policy conversation acknowledges. When ATM density falls below the threshold where a significant portion of the population cannot access cash within 30 minutes of their home without dedicated transportation, cash has been functionally eliminated for those populations regardless of its legal status. Third, watch the cash transaction reporting threshold in the United States. The current $10,000 Bank Secrecy Act threshold has been the subject of proposed reductions to $3,000 and even $600 in recent legislative cycles. If the reporting threshold is reduced, making routine cash transactions subjects of federal financial surveillance, the chilling effect on cash usage will be immediate and dramatic. Not because cash becomes illegal, because using it above trivial amounts becomes associated with the presumption of criminal intent that the reporting requirement implies. Fourth and most critically, watch the programmable money pilots being conducted by commercial banks in partnership with central banks. The Bank of England, the Bundesbank, and the Monetary Authority of Singapore have all conducted programmable money pilots, experiments with digital currency that carries embedded conditions on how it can be spent, where it can be spent, and when it expires if unspent. Programmable money with spending restrictions is not money in the historical sense. It is a conditional voucher system that gives the issuer complete control over the economic behavior of the holder. When programmable money moves from pilot to deployment, when the conditions embedded in your digital currency can be changed by administrative decision rather than legislative process, financial control architecture that the cash elimination was always building toward becomes operational. Here is the final truth that every monetary transition in history has eventually forced ordinary people to confront. Money is not just a medium of exchange, it is a form of freedom. The freedom to transact privately, the freedom to save without permission, the freedom to exist economically outside the visibility and control of any institution that might wish to direct, restrict, or tax your economic behavior for its own purposes. Physical cash is imperfect. It is inefficient. It facilitates crime at the margins in ways that its defenders must honestly acknowledge, but its imperfections are the price of the freedom it represents, and the entities working hardest to eliminate it are not primarily motivated by the crime it facilitates. They are motivated by the freedom it provides, the freedom that stands between the monetary authority and the complete financial control that the elimination of physical cash makes possible. The cash squeeze is not coming. It is here. It has been here for a decade. And the window between understanding what is happening and retaining the practical ability to do something about it is measured not in years, but in the specific finite, rapidly contracting timeline of ATM closures, branch shutdowns, merchant refusals, and CBDC implementations that are converting the theoretical elimination of cash into the practical reality of a world where your money exists only in a form that someone else controls completely. The question has never been whether they would do this. The question is whether you understood it while you still had options. And the answer to that question, the most financially consequential answer in your lifetime, is being written right now by decisions being made in central banks, in treasury ministries, and in technology companies that you were never asked to approve,